Hi, everyone. We would now like to spend some time looking at examples around these exceptions where we talked about the recognition and the measurement criteria, right? To start with, we have this example on indemnification assets. It says that on 1st of April 2018, X Limited, which has been sued by one of the clients for a breach of a contract of 2.5 crores, is acquired by Y Limited, right? So there is an acquirer, which is Y Limited, and there is an existing client which has filed a case against X Limited for a contract worth 2.5 crore rupees. Now, as per the terms, the sellers of X Limited provide an indemnification to Y Limited for reimbursement of all losses greater than 1 crores. Collectability issue is not there. So effectively, in case there is some something that arises, that anything above 1 crores is expected to be, of course, paid, right? Now, on the acquisition date, Y Limited determines that it's a present obligation and, of course, recognizes the fair value of the contingent liability of 2.5 crore rupees there. So if this court case, which is there against the acquiree X Limited already, that is recognized at 2.5 crore rupees in the books of Y Limited because there is a present obligation in place, right? Also, Y Limited shall recognize an indemnification asset to the extent of the differential amount that would be recoverable, right, from X Limited, and that's where you start looking at the recognition of both the contingent liability and the corresponding indemnification asset at the time of the goodwill recognition or at the time of purchase accounting. All right. Let's have a look at another example. It says that on 1st of April 2019, Tom acquired Jerry, which is a subsidiary of Bluto Limited. On the date of acquisition, there is a pending court case against Jerry Limited where the customers have alleged Jerry Limited for a breach of contract of 5 crore rupees. In this case, Bluto, that is the parent, has indemnified Tom Limited for all the losses up to 4 crore rupees, and the fair value of the contingent liability is 3.5 crore rupees. The question is, how should Tom Limited account for the contingent liability and the indemnification asset? Also, what if the fair value of the liability itself is 6 crores instead of 3.5 crore rupees? Now, importantly, you bring again the thought process as far as the contingent liability is concerned. Right? If there's a contingent liability, if there exists a present obligation, right? In this case, of course, there's a court case going on and there's a expected breach. So to that extent, this becomes 5 crores, okay? And then we are saying also that the fair value of the court case. So this is something which is the value of the court case or the pending value of the suit, and the fair value is given to be 3.5 crore rupees, right? You need to consider this part that the parent is giving indemnification to the acquirer, Tom Limited, for all the losses up to 4 crore of rupees, which simply means that while the fair value of the contingent liability would be recognized at 3.5 crores, a corresponding indemnification asset is also recognized to the extent of the recoverability. All right. So when you look at this formal solution, we're looking at, of course, both the contingent liability at its fair value and the corresponding indemnification asset would be recognized there, right? But now we're also provided, what if the fair value of the liability is 6 crores and not 3.5 crores? Now you're provided also that you are only going to get an indemnification up to 4 crore rupees, which now means that in the second scenario, you would Liability, you would be recognizing to the extent of 6 crore rupees as the same logic. But of course, the indemnification asset only to the extent of recoverable will be recognized, which is not more than 4 crore rupees there, right? That's something simply the extension of what we have discussed in the previous example as well. All right. Let's have a look at another example. It says that on 1st of April 19, Tom acquired Jerry, a subsidiary of Bluto, for 100 crore rupees. On the acquisition date, there is a pending court case where the customers have alleged Jerry for a breach of contract. Now, in this scenario, Bluto agrees to indemnify Tom for any adverse results up to 5 crore rupees. Now, the class action has not specified any amount of compensation, but the experience suggests that there could be arising a liability up to 2 crores, but that's normally settled for a fairly lower amount, right? It also makes the acquirer makes an assessment that due to the potential variances, the contingent liability cannot be measured reliably, and accordingly, no amount is recognized in the court of in respect of this pending court case. The question is, how do you deal with this? Accounting for the indemnification asset. Now you know that there's a recoverability up to 5 crores there. The liability amount is expected to be 2 crores, but the reliable measurement cannot be done. Now, of course, we are simply saying that if the reliable measurement can't be done, right, neither the contingent liability nor the indemnification asset, they can be, they can be recognized. So simply saying that as the liability is not recognized, accordingly, the indemnification asset would also not be recognized as far as the books of the acquirer, which in our case is Tom Limited, is concerned. All right. Now, this is something which is, the broader coverage, which we wanted to cover through the exceptions chart. So when you look at an existing lease arrangement and acquiree is the lessee, then simply the right of use asset and the lease liability, as we have discussed under the Ind As 116 framework, okay, is there, then you continue to recognize that, right? There's no fair value of an asset or a fair value of a liability under the question. So that's why this becomes an exception there. Okay. You may not require any, you may not recognize any right of use asset or lease liabilities for those exceptions under Ind As 116, which is basically your short-term asset or low value asset. Okay. The lease liability is nothing else but the present value. And of course, the ROU is the same amount as the lease liability. So effectively, you are simply following the principles of recognition and measurement under as applicable under Ind As 116, which is leases, right? You don't really follow the fair value criteria as far as such kind of contracts are concerned. Now, in case the acquirer is a lessor, right, you need to consider the terms of the lease. You don't have to recognize a separate asset or a lease liability in case, for example, there is a operating lease, right? So if the terms are either favorable or unfavorable when compared to the market term, you do not have to do any further adjustment around that. Okay. On the reacquired rights, basically what you need to understand that, when you look at these rights, these need to be recognized as an intangible asset on the basis of the remaining contractual term, right? That's something which is the consideration that you need to bring in, right? There could be examples like a license to use the brand name, franchisee rights, etc. Then the whole idea of the recognition of those reacquired rights is basically, right, any favorable terms, for example, right, would result into a, let's say, a gain, or any unfavorable terms would result into a loss, and accordingly that would be dealt with as a separate transaction, right? So the whole idea is that when you look at such rights, these are the rights which acquire may have granted to the acquiree, right? But then it's not important, for example, whether those rights were already in place as far as the books of the acquirer were concerned. A little conceptual again, but you would want to find some merit around it. Okay, let's have a look at the this side of the discussion where we talk about the identifiability criteria, right? As far as intangible assets are concerned, we say an intangible asset would only be recognized if it meets the identifiability criteria, even if it is not transferable or separable from the acquiry from that context, right? There's some basic examples which help us evaluate, which help us understand that in case you are acquiring a business of another entity and it has some intangible assets in place, then till the time and as far as those intangible assets meet the identifiability criteria, you shall recognize those as well on the basis of their fair value in the books, as an acquirer. Okay, let's take an example here. It says that an acquiree owns and operates a nuclear power plant. The license to operate that plant is an intangible asset, right? That meets the criteria and would be recognized separately, right? It's not important whether the acquirer cannot sell it or it cannot transfer it separately, right? So accordingly, the fair value of the license has to be recognized and has to be, of course, shown in the books of the acquirer. Okay. Likewise, it says that an acquiree owns a technology patent. It has licensed that patent to others for the exclusive use outside the domestic market, right? There is a royalty arrangement. There is a specific percentage of future revenue expected. Both the technology patent and the related license again meet the recognition criteria, right, of identifiability. Although there's a restriction in terms of the sale or transfer or cancellation of that. So it does not bother, right? Effectively, such kind of intangible assets or arrangements would need to be recognized in the books of the acquirer at their fair value. Okay. Let's have a look at several examples around it. It says that market participants, again, this term is always coming from Ind As 113, fair value measurement, right? They exchange deposit liabilities and related depositor relationship, intangible assets in observed exchange transactions, and accordingly, these depositor relationship intangible assets, are recognized separately from the goodwill, right? So let's say an acquiree owns a trademark and documented, right, but unpatented technical expertise used to manufacture the product. Transfer the ownership of the trademark, the owner is also required to transfer everything else necessary for the new owner so that the new owner can actually use it for its business purposes. Now, the unpatented technical expertise must be separated from the acquiree or the combined entity and sold if the related trademark is sold. So that criteria of separability is, of course, met there, right? Similarly, customers and subscribers lists would meet normally the separability criteria. So even if the acquirer believes that these lists are different from other customers lists, till the time these are licensable or licensed, they would meet the criteria of separability, right? Just generic thought process around what could probably be the examples around separability. This is more detailed, understood when you go back and look back at the Ind AS 38 standards discussion. Okay. Now, importantly, what you also want to remember, a customer list would not meet the separability criteria in case there is a restriction or a confidentiality arrangement wherein you cannot use that list at all, right, as far as the customer's information is concerned. So there could be data privacy rights or data protection rights, etc. So in those lines, in those parameters, you would not be able to consider these or call these as a separate intangible asset. That's something which is the idea here. Okay, let's have a look at this scenario. It says that on 31st of March 19, A acquired B in a business combination. B Limited operates a diagnostic testing center and provides testing facilities such as X-ray, CT scan, blood screening, etc. As B Limited is an established name in the region, patients walk in independently and are also referred by medical practitioners. As an operational practice, B Limited maintains a database with each patient's information. All the relevant information is there. However, this is protected by privacy laws, and B Limited cannot sell, transfer, or otherwise exchange it. Right? Should such customer list meet the criteria, meet the definition of an intangible asset is the question. Right? Now, effectively, since the privacy law and regulations prohibit the use, sale, transfer, license, or exchange of this information, the separability criteria is not met. It simply means that no value can be assigned to the customer list. No value can be assigned to the customer list in this case because the separability criteria is not met, right? In general, whether you can consider the relationships as an intangible asset would certainly depend on a lot more information. But as far as the list is concerned, there's no reason to believe that it can be recognized separately as an intangible asset. Okay, let's have a look at this scenario. It says that on 31st of March 19 is in a business combination. Y Limited acquired Z Limited. Now, Z Limited is a manufacturer of glass bottle, and the company has a fixed contract to manufacture to one of its main customers. Now, would this contract be eligible to be called as an intangible asset? Now, necessarily this meets the separability criteria because there is a relationship with the customer and, for that matter, the contract. So both aspects, the bottling contract and also the relationship are recognized at their respective fair values on the acquisition date. Okay, that is something that you want to consider in such examples, right? Now, again, if I just halt here, if I just take a step back and try to understand how my examination assesses me on such things, right? They might give me, a scenario where there is one company which is acquiring another company, okay, and one of those discussions may include, let's say, such kind of contracts, or let's say the customer relationship, and they may assign a fair value to those as well. It would be very important to understand that whether those separability criteria are duly met here or not. That is something that you want to always bear in mind. Okay, let's have a look at another scenario. It says that on the 31st of March 19, in a business combination, H Limited acquires G Limited. G Limited is a tours and travels planning company. As an operational practice, G Limited establishes customer relationships through contracts. However, the business combination is affected during the period which is G Limited's off season, and therefore it does not have any active contracts in place with customers. Now, do you believe that such kind of customer base or the customer relationships qualify to be to be meeting the separability criteria? Okay, what I was saying here is that in this case, as there are no contracts in place, first of all, so it cannot recognize the customer contracts at all. But at the same time, the relationships would meet the criteria because the establishment of those the customer relationships has been happening through the contract. So in those contexts, you would see that the customer relationships are recognized separately and measured at their fair values. Okay, let's have a look at another example. We are saying that Peter Limited, which is the retail company, acquires Pluto Limited, an online e-commerce company, with the intention to take its retail business online. Pluto Limited over the years has developed a database of 50 lakh registered users. However, Pluto does not have any intention to sell this customer list. The question is, should this customer's list be recorded as an intangible in the business combination, right? Believe me, it does not make a difference. We are not talking from, Peter Limited's perspective. We are not even talking from the Pluto Limited's perspective. We're talking from the market participants' perspective, right? So in the context here, the the intentions of the whether this list will be transferred or not may not be relevant. Okay, that assessment of whether to record is intangible or not does not matter as far as the intentions not to transfer is concerned, right? However, the value of the database has to be assessed, and accordingly, whether this give right to some legal or contractual right is also a critical question to be able to bring that assessment, right? So in these cases, you would normally see some value assignable unless the you know the list is redundant, or it talks about some details which are not relevant in today's time or at the time of acquisition. In those cases, the value may not be measurable. So identifiability is one aspect, but the measurement aspect is also critical to observe. Okay, let's have a look at another example. It says that Blue Limited is a successful company with established markets across India. It has a number of its own retail stores and also offers franchising. White Limited is one of the franchisee and operates number of retail stores in western part of India. So due to White Limited's popularity and its huge distribution network, Blue decides to acquire White Limited, and on 1st of April 19 purchases the outstanding shares of White Limited. On the acquisition date, Blue determines that the license agreement reflects the current market terms. So there are pre-existing relationships between Blue and White, right? So effectively they would get cancelled with each other, and there would not be any gain or loss recognized because the value of the license itself is measured at its market price. So that's something which is going to be the story around that. Okay, the final leg of discussion you want to pick up is the direct cost of acquisition, right? You might be spending money on, for example, let's say talking about the brokerage or consulting fee or advisory, or you would have some fee payable to merchant bankers, etc., or valuers, or doing some due diligence and stuff like that, right? These costs, to the extent these are incurred by the acquirer, for example, these are all expensed, right? Of course, even if these were incurred by the acquiree, they're all charged to the statement of profit or loss. The only question that remains is that, are you probably issuing shares to those external parties like consultants or bankers, etc.? If you do so, then those costs shall be adjusted from the cost of equity, right? So anything which is effectively paid in form of equity, that expense has to be charged against the equity itself, right? But something which is paid in terms of, let's say, cash, for example, then you need to charge it in the statement of profit or loss, right? Likewise, if there is a loan or a debt issued, to that extent those costs should be adjusted from that debt. So practically the accounting that follows here is impacted from Ind As 109, which is financial instruments, right? That's what you want to remember. But the key note that you want to bring along is that all direct cost of acquisitions, with respect to advisory, legal, accounting, valuation, etc., these are all charged to the statement of profit or loss. Any cost of issuers of debt or equity, as we said, should be recognized or should be measured and recognized through under the principles of financial instruments. All right, let's do a quick revisit of what we have all discussed so far. The recognition, we should all recognize those assets and liabilities which meet the recognition criteria. Okay, at fair value, that's the measurement criteria, of course, right? NCI, we'll be discussing it as when we discuss the next section of goodwill and bargain purchase. That's where the NCI has a role to play. So we'll be talking about that in detail, right? There are exceptions for the recognition or measurement with respect to contingent liabilities. Measure them at fair value if there is a present obligation. Reacquired rights are being cancelled. Share-based payment transactions asset held for sale and employee benefits, and for that matter, even leases, they would be recognized as per the respective standards, right? Intangible assets, we would recognize them if these are meeting the separability criteria. Indemnification assets, till the time there is a contingent liability, to that extent, indemnification assets are recognized. Income taxes becomes a clear exception. We have dealt with detailed examples around those. All right. Thank you very much.